Hello to all, and thank you for joining us from all over the globe today. I hope you and your loved ones are staying safe. I am Anisali. I look after NRI products with ICICI Bank, and we are delighted to welcome you all today. Today, we shall be talking about a story we all love, the India story. In this, we will cover the economic dividends and structural measures driving its growth. Now, to share his thoughts and insights on this complex subject, it is our pleasure to have with us today Mr. Pankaj Pandey, who heads the retail research at ICICI Direct and has been with ICICI Securities for the past 20 years. Under his leadership, the ICICI Direct research team tracks over 100 companies across 16 sectors in the large, mid, small, and micro cap universe. He also leads the technical derivatives and desk for ICICI. So, with this brief introduction, I will now request Mr. Pankaj to share his thoughts with us. So, over to you, Pankaj.
Thank you, Anish. Hi, all. Warm welcome to this investor session. And for today, I'll broadly talk about the India story, which is the strongest ever we've seen up till now. Coming to India story, Indian growth is anchored around structural transformation which the country has been experiencing. And now some of these are repeating. So India definitely enjoys a distinct advantage compared to the global peers, and the prominent areas where this distinct advantage is one obviously is the demographics. So a number of bigger economies are likely to experience a deterioration in demographics. Contrary to that, India, on the other hand, is going to have nearly 69% of their population in the productive age of, say, 15 to 64. And even the median age for India is going to be quite low, below 30 years of age. And now coming to macro stability, overall lower inflation is required to sort of achieve a very sustainable or a durable growth rate. And globally, post-COVID, we've seen inflation has been a big challenge across economies, be it US or other geographies as well. And that leads to growth volatility. India, on the other hand, has been sort of experiencing a very stable inflation, and past 3 years we are experiencing 7% plus real GDP growth rate. And that is attributed to the fact that RBI adopted a inflation targeting framework in 2016 with an inflation target of 4% plus 2 or minus 2%. And the perspective is to keep interest rates or real rates positive, and which is why if you look at current levels, you have a repo rate at 6.5% and inflation at 4.5%, and likely to stay around these levels for next 1 year as well, given also the fact that monsoon is expected to be good. So we are offering a real positive rate of 2%, and that is leading to a more durable and sustainable GDP growth rate. Some of that is already visible, at least in the past 3 years. Another interesting thing is that India, in terms of private debt, so which is where we sort of include the corporate plus the household debt. Now, this is the parameter of the strength of the economy. So this debt to GDP is at about 50 odd percent, and global average is about 145%. US is, I guess, is somewhere about 220 odd percent. Now, what this indicates is that the households and corporates in India are witnessing good balance sheets, and their capability to sort of consume and sustain that consumption holds in good shape. So that is also a very distinct advantage for India. There are two more things which are sort of shaping up the world. One is the deglobalization. I think what we are sort of clearly experiencing is that a lot of countries are looking to diversify their global supply chains. And India overall has not been participating there, except for IT exports. We really are not a big exporter. But going forward, our sense is that deglobalization will lead to rewiring of these global supply chains, and stands to gain from this. And I'll also come to the reform measures what the government has taken to sort of up the manufacturing leg of the economy. And decarbonization is another tailwind which is putting India in a sweet spot. Largely because our legacy capacity in terms of, say, for example, a thermal capacity is quite low. And so for us to transition to renewable energy is less of a challenge compared to Western world. And what was sort of disadvantage is now a slight advantage for us. Now, while these are distinct advantages, what we have, it's not that the government has not been taking some of the measures. So we have seen ample number of measures being taken on the taxes side. Taxes I'll highlight a bit later, especially on the GST side, both indirect and indirect direct taxes. The government has taken decent amount of measures. And digitization is another factor which has helped the country in reaching out to masses in times of stress. So we are already running one of the largest farmer welfare schemes, and obviously that was not possible without the digitization what the country has seen. Then IBC has been one major reform because for any economy to do well, the banking sector needs to be in good shape. And historically, we've seen good amount of volatility in the banking sector. So IBC is a major reform. What you are clearly experiencing post implementation of IBC is that there is this behavior change what you see in terms of borrower, because no owner wants to lose control of their company. So which is why we see a good number of cases getting withdrawn before they get admitted to these specialized courts called NCLT. And also we are seeing decent recovery rate for companies which are part of the NCLT. So it's a one structural reform which is yielding it benefit not only from economic perspective, even for the banking sector, which I'll come to later. Now, real estate is another big sector which is extremely important from an economic perspective, because real estate, at least in India, is one of the largest employers of unskilled labor. A lot of sectors like, say, for example, paints, you have consumer durables, home building products actually rely on real estate to sort of do well. And here we've seen overall revival after a decade, especially in the real estate. And this has happened post the implementation of RERA, and which is bringing on significant changes, which I'll come to later. I think the kind of challenges what one is seeing in a big country like China, India had sort of already experienced that a decade back. And post-era, a lot of issues are sort of resolved, or at least we are not staring at those kind of problems. GDP remains healthy, and which is what has been the case in the past few years. And I'll come to the corporate earnings as well. Now, coming to taxes, I would want to highlight the GST. So GST is one tax. If you sort of look at monthly collections, so this was introduced in 2017, and post that we've seen that the monthly GST collections have actually doubled. And this is one system or tax which has been sort of a success for the government, and is definitely helping the government to maintain its fiscal prudence, and which is why the government is able to sort of allocate more resources towards productive causes. I spoke about banking. So banking obviously is a big sector for the country, and banking as a sector struggled for a good period of time. And as a result of that, the corporate earnings also suffered. So 2017 to 20 was a period when there was literally no growth in earnings. And post that, we have seen that a lot of IBC cases got resolved, and things have started sort of improve. So from there on till 2023, we've seen the overall Nifty earnings. When I'm sort of displaying its Nifty earnings, I'm talking about. So Nifty earnings from 2020 to 23 literally doubled. And from there on, what we are seeing is more of a steady kind of a growth up till now. And even going forward, we are going to see 14 to 16% kind of a overall growth in the corporate earnings for top companies. Now, one obvious question is, while the earnings have gone up, has it really hit the peak? And one way to sort of compare is to look at the previous good cycle. So we had a previous good cycle in the time frame of say 2003 to 2007 or 8. And that was the time when the corporate profits as a percentage of GDP was 6.4%. And currently we are closer to 5%. So we're still not at the peak. And this is true even for when you sort of dissect in terms of large caps, mid caps, and small caps. So large caps, while the peak was some 4.4% of profits as a percentage to GDP, currently it's about 3.6%, and mid caps are largely there in terms of similar peak. But small caps are literally half of in terms of what it was earlier in 2007-8. And so from that perspective, our sense is that while there is a recovery in earnings, but it is still not the peak what we have seen historically. Now, when we sort of look at manufacturing is one segment which the government has been sort of highlighting. And we've seen that government coming up with PLI or production linked incentive scheme, where it is spending closer to 2.65 lakh crores. This is excluding the semiconductor incentive which the government has sort of announced. And what they're aiming for is nearly a $520 billion kind of a jump in the overall manufacturing output. And manufacturing as a leg of the economy has been sort of silent, and we are largely a services-driven economy. But like I said, we are seeing a rewiring of these global supply chains, and India is expected to sort of be a beneficiary of this. So this PLI scheme is largely to sort of address the disincentive or the disadvantage Indian companies have in the range of say 5 to 7 odd percent for for every product what they manufacture compared to big countries like China. So this is sort of just to create a level playing field for the companies. And at least in mobiles, we have seen a good amount of success. And our sense is that manufacturing as the leg of the economy is definitely going to take shape. And I'll come to other factors later. Now, while the overall capital expenditure or capex, as we sort of call, is one of the growth templates which the government has been following. But what we are also seeing is there is a shift in the income and the consumption structure, what we are clearly sort of noticing. And going forward, I think this trend is going to be even more visible. Expectation is that the GDP per capita is expected to sort of grow from say $2,500 per year to about $5,500 by 2030. And households which are earning more than 3 million, that is expected to more than double to 3.5 million. 35 million. And even when you sort of look at one grade or one level below 0.5 to 3 million category, there also we are expecting nearly 60% jump in the number of households. And what we are clearly seeing in terms of in the initial days of this is that we are clearly seeing hospitality as a segment sort of doing very well. Most of the hotels in India have been sort of doing very well. When we sort of look at auto consumption, 50% of the auto consumption is happening in SUVs. So sedans have sort of taken a back seat. And similarly, for a lot of other categories, we are seeing good amount of premiumization as a trend coming up. I'll come to the auto specifics later. Now, while everything sort of looks good, how to sort of participate in this story in terms of sectors. Now, given the fact that the capex has been the major focus of the government, I think the beneficiaries of that are going to have, or these are the sectors which are going to witness a longer rope for growth. So capex beneficiaries of are obviously you have companies in the capital goods side or infrastructure side. Cement and steel become the core sector to sort of participate. I already highlighted that the government has taken structural reforms in BFSI and real estate. So these are the two sectors which are going to benefit even further. And since there is a decarbonization sort of going on, what we see is that power, where we derive power largely from thermal sources or through coal, I think that is seeing a fundamental shift. Sectors like power and auto are another set of segments where I think which are expected to sort of do well for the next decade. Now, overall, when we look at capital expenditure, so last 5, 7 years, the highlight of this government has been the capital expenditure. Last 4 years, we have seen capital expenditure growing by 30% CAGR, and it has literally doubled from 1.6, 1.7 odd percent to nearly 3.3 odd percent. And so from that perspective, we are literally sort of doing good amount of capex there. And a good part is that the two sectors that stand out in terms of maximum allocation of this capital expenditure is road and railways. And these are very important sectors because you need physical infrastructure for India to sort of evolve as a manufacturing hub. And another disadvantage historically for us has been that because we never had this kind of infrastructure, so logistic cost was high at about 14 odd percent. Ideally, it should be in single digits, which is what the government is aiming for. So I think government is focusing on the right places in terms of railways, and which is why the manufacturing leg of the economy is expected to sort of do well. In terms of the color of capex, up till now, say last year, overall capex is about 26 trillion rupees. A bulk of it or heavy lifting has been sort of is being done by the central government. And what we are also seeing is that the private sector capex has started to sort of inch up. The commentary from most of the companies regarding capex has definitely improved. And state is another. So states have also sort of become competitive. So which is why we are seeing state capex are also sort of happening. But of this entire capex, the bulk obviously is going towards energy. So at least half of this capex is going towards energy. But another interesting thing is that we are seeing new segments of capital expenditure being coming up. So, for example, data center is one because India consumes a lot of data, or Indians consume a lot of data. You need for that data to reside in the country, you need data centers. Then electric vehicles are something which is started to sort of take shape. Defense is one sector where there is a 360-degree turn. So rather being an importer, we are trying to become an exporter going forward. And a lot of other manufacturing segments, including green energy. So the complexion or the texture of the capex is also sort of changing a bit towards new age sectors. Now, railway is one segment which is sort of getting its due after a long period of time because railway overall carries good amount of economic benefits. Now, what we have seen is that historically there's hardly been any investment in the railways. But the government has come up with a national rail plan wherein they are looking to spend about 15 trillion rupees in the next few years. And now this capex is going to happen in the rolling stock. So you'll have more wagons, coaches, locomotives, or what you sort of see is more of an infrastructure improvement. So we have freight corridors which are coming up. I think by this year end, we will have both eastern and western dedicated freight corridors. And one benefit of that freight corridor is that this was the year. See, typically the power demand is quite high during the month of May or during summer season. I think this is a time this year we have not seen any kind of outage because the railway has been able to carry that extra coal for the incremental power demand which comes up. And railway obviously has a lot of benefit because overall sense is that the freight it carries is about 26 odd percent. Ideally, it should carry more because of the cost benefit it carries. So overall plan is to sort of take it to 45%. And so not only that, we are looking to sort of, or we are seeing decent amount of announcements on the Vande Bharat trains, especially on the passenger amenities side. So railways getting its due after a long period of time. Now, road, we have already seen a decent amount of focus. So the road infrastructure definitely has sort of improved. But I think the plan is to have or to make it even more better. So overall capex there is expected to be about 20 trillion rupees. And the one aspect of that is that every major city, I think, will have access to some high-speed corridors by 2032. So that is what the plan is. And from an existing speed of say 47 kilometers per hour, ideally the aim is to take it to about 85 kilometers per hour. So from that perspective, overall sense is that the kind of speed what people sort of achieve when they drive on the road, especially in the Western world, I think we are looking to sort of, or we are aiming to sort of achieve that in that direction. So I think road is another sector besides railway, which is very crucial for this manufacturing to sort of overall manufacturing as a segment to sort of take shape. Now, nothing happens without core sectors like cement and steel contributing. And overall, see the kind of capacity addition which used to happen in cement as a sector. Uh, 2019 to 23, we have seen about 87 million tons kind of capacity being added. Now, in the next 4 years, we are going to add nearly a double of that kind of a capacity. And the overall anticipation is that the cement demand is going to grow at 8% CAGR. And since real estate as a sector also has started to sort of do well, because housing consumes nearly 60% of the cement demand. So one, obviously, it will entail a good amount of capex of 1.5 trillion. The other aspect is that the capacity utilizations are expected to be healthy for the sector, given the fact that, like I just highlighted, the demand is going to be at about 8 odd percent in terms of growth rate. So this is one sector which is also going to sort of benefit. Now, steel is another sector which is extremely important because any country which is building up infrastructure, typically the steel demand grows more than the GDP growth rate. And when you sort of look at the pecking order, say 2023 calendar year, the overall steel capacity is 1,888 million tons. And China obviously is the biggest producer. And next is India with 140 odd million tons. But good part is that we are the only country which has experienced a double-digit growth of 12% in steel demand and production. And overall sense is that in the next few years, by 2030, this capacity is going to be doubled to about 300 million tons. And unlike cement, it's a very capital intensive sector. The capex requirement here is expected to be 10 to 11 trillion rupees. And when you look at top companies, the likes of Tata's or JSW or and others, I think the overall capital expenditure by these players is literally doubled. So from 25 or 250 billion rupees to about 500 billion rupees. And while when you look at the recent numbers, or when you look at the price performance from this sector is not doing so well, largely because if you sort of notice, the recovery in the China is still weak, and which is why a lot of dumping is going on. But our sense is that the government might take some measures going forward, because if an industry is spending so much in terms of building capacity, it can't be left to sort of fend off for competition without government intervention. So from that perspective, steel is another sector which we are liking. Although from a price performance perspective, this is one sector which has not really delivered in terms of the share price performance. Now, banking is extremely important from an economic perspective. So when the banking was in a bad shape, the credit growth got impacted. So credit growth was under 10%. You had NPAs were quite high. So gross NPAs were in double digits, which has sort of come down to about 2.8 odd percent, and is expected to further come down in FY25 to 2.5%. So which is a 12-year low for the banks. So asset quality is really very healthy for banks. And when the banks were undergoing trouble, what we have seen is that the sector was sort of making losses because most of the banks had to sort of do a heavy provisioning. But all that is a thing of past, and from there on, we have seen a very consistent recovery across. So you are seeing a multifold jump in the profitability of banks, most of the banks. And the benefit with IBC is that the volatility, what you see in earnings, is going to be pretty less. Unlike in the past, where a lot of promoter owners used to take banks for a ride. So I think so from that perspective, given that the borrower behavior is changing, we are expecting this sector to sort of deliver a stable set of numbers. Real estate is a big sector, like I highlighted. Now, real estate sector is also witnessing a revival after a decade. So, in the worst of their times, the sector was sitting on an inventory of nearly 55 months, which has now come down to about 15 months. And this has happened even despite the fact that the interest rates or home loan rates have gone up by 200 bips. So from 7.2%, it has gone up to about 9.2%. So despite that, we have seen at least top seven cities, the premium segment of the market has done very well. And our sense is that when the rate cuts happen, because there is an increasing anticipation that Trump might come in and that might, or at least the markets have started to factor in two rate cuts in the US. And that will provide some leeway to RBI also to sort of cut rates. And we are already well placed on the inflation side. So the overall growth rate in the real estate is expected to be more broad based. The other thing is that real estate sector, or when you look at companies like most of the companies, I mean, be it Godrej, be it Prestige, Brigade, a number of other companies, they used to be localized players, but now what you see is that most of these players are now entering into different markets. So it is becoming a pan-India exposure is what they are looking at. And this has happened because of RERA, because in RERA, for every project which is being launched, the companies need to open an escrow account, and you cannot really shift that money to some other projects. So money has to be collected for that and has to be spent for that purpose only. So which was a very fundamental change which RERA has brought in. And as a result of that, we are already seeing benefits of that. What we are clearly seeing is that the organized share, which used to be about 5-6% of the industry, has gone up to 20%. So our sense is that even if the segment does not do well, the listed space is expected to gain further more market share, and which is why you'll continue to see the real estate companies doing well. I think they've already done very well last year, both in terms of price performance, also in terms of the kind of volume growth. This year also, most of the prominent players are talking of 20% kind of a growth rate in sales. So, real estate is as a sector is looking quite encouraging. Now, transition towards green energy is one of the big realities today, and every economy is looking to sort of do that shift, and India is no far behind. And overall sense is that renewable energy capacity, which is somewhere about 172 gigawatts, is ideally expected to go to 466, and now we are started talking about 500 gigawatts as well. So you are literally seeing doubling of the capacities, and this entails the massive capex of nearly 25 to 30 trillion dollars. And what I also highlighted in terms of capex was that you are already seeing capex, especially on the energy side, being quite high, or being 50% of the overall system as well. And so while it has benefit in terms of decarbonization, it also throws an opportunity for a country like India to become sort of a leader in producing green hydrogen. Now, the thing is that India enjoys a good amount of solar radiation, and solar cell or the power cost is one of the biggest cost component for producing green hydrogen. So since India enjoys good radiation, the overall expectation is that if India is able to serve, or if companies which are participating in this, if they are able to produce hydrogen at a cost effective price, then they can become big exporters. So when you sort of some of the overall plans of most of the companies, what we are eyeing as a nation is a 10% kind of a market share in the global demand for green hydrogen. And obviously, this will not happen without the kind of capital expenditure required. A significant amount of capital expenditure is required. And one more interesting thing is that this is one segment which is chased by the private sector or private corporates in a big way. So you have big companies like Reliance, which are looking to sort of produce polysilicon to everything in-house to keep a tab on the cost. And same is the case with Adani. So maximum amount of capital expenditure allocation by them is towards this segment of the market. And besides that, a number of other listed, unlisted players, even companies like L&T are looking to sort of participate through electrolyzer. So this is a very interesting development, and it can have a far-reaching impact on the economy. Just to highlight, so we spend nearly 10 trillion rupees bare minimum on importing crude oil. And obviously, it has its own set of implications in terms of it causes currency volatility, it causes inflation, and obviously, the macroeconomic stability also sort of gets questionable certain times. So if we are able to sort of address this structural problem, I think we could have a situation where the interest rates are stable, the currency is stable, and obviously from an importer of energy, we can become an exporter of energy. So this is a very interesting development, which we feel has a long way for growth for India. I already highlighted that auto as a segment is doing very well. Most of the segments, as CV is expected to surpass the pre-COVID highs or lifetime highs this year. We have already seen passenger vehicles surpassing, or sales are at a lifetime high levels. The two-wheeler is also a similar case. One more thing which is interesting is that the average selling price of the industry has actually doubled, or has gone up, by 50% in the last 5 years. So from 7.65 lakh rupees a unit to about 11.5 lakh per unit. And what you clearly see is that there are some products like, so for example, alloy wheels becoming a standard feature, or panoramic sunroof becoming now a standard feature rather than sort of a luxury offering. But even in terms of luxury, India offers a good amount of scope to sort of grow. So while globally, when you look at the luxury as a segment of the market, contributes 10%. In India, it's about 1%. So I think even the luxury segment has a good runway for growth. And auto is another sector which is seeing good amount of capex because of the shift in the energy transition which we are seeing, because IC engines are expected to be eventually replaced by lithium ion batteries or EVs. Now, when we sort of look at how is our market sort of responding to all these changes, so one is we are already one of the best performing markets, and it's clearly reflected in the numbers. Most of your indices are at lifetime high levels. So last 1 year, the index has delivered about 26% kind of returns. So market is clearly sort of favoring that. Now, while everything looks good from a domestic perspective, there are global risk, or you get a lot of other risk as well, which causes correction in the market. So rather than sort of highlighting the risk, what I'm trying to highlight is that because of all these factors, we get a correction in the markets. And so in a large cap category, you could get a correction of 10 to 15%, which is a very normal correction which happens. Mid caps, since they offer higher return, the correction could be higher in the range of 15 to 25%. And the small cap obviously will witness even more steeper correction in the range of 20 to 35%. But that's a sort of a normal correction to sort of expect. And this has been there for more than, say, 15, 17 years, except for big events when you had Lehman crisis in 2008, or when you had COVID issue that impacted the markets much more across caps. Otherwise, domestically, the risk elements are less. I think globally, it is possible that there might be some event which could lead to these kind of corrections in the market. But overall, what our sense is that one, we are seeing with the kind of growth rates India is already delivering, India could be a 7 trillion GDP size by 2030. Because 7 to 8% is the kind of a growth is very much we are sort of already experiencing. And if we are able to sort of achieve what we want to achieve on the manufacturing side, the growth can be better than 7%, so possibly 8% or even more. And like I highlighted, we would have a pretty young population and a pretty young workforce. And we are already seeing some of the benefits accruing. Now, what it does to equities is that if your GDP is going to grow at, say, 7% with inflation at 4.5%, so what you're looking at is a 11.5% kind of a nominal GDP growth rate. Now, best of the companies which is represented in Nifty or the large cap index obviously do better than the economic growth. So 12 to 15% kind of a growth is a basic expectation to have in terms of the earning growth. So Indian equities is something which can comfortably deliver double-digit kind of a return. Now, before I sort of conclude, why we are sort of bullish on the market from a very structural perspective is that one, 2003 to 2008 was the best time for the markets. At that point of time, two broad themes were playing out very well. One was the real estate as a sector was doing well. The other one was the capital expenditure was doing very well. We see similar stances now also because real estate is doing very well. Will broaden up once we get the interest rate cut, and capital expenditure I highlighted across sectors. And so when these two cycles pan out, you had one of the best performances in the Nifty during that time. So those 5 years, the Nifty did 5x, the mid cap and small caps. If you sort of look at any kind of a mutual fund which combines both the large, mid and small cap, that did 9x. So not to say that we are going to see those kind of returns, but the similarity what we see is that both the times these two strong themes were playing out, and obviously it has multiplier benefits. On top of it, there are other benefits because of paucity of time I'm not including. So overall, there is an expectation that with the inclusion in the bond index, we could be getting about $25 billion kind of annual inflows. What it does is that it leads to lesser currency volatility. Your interest rates can be a lot more stable because the crowding out of investment does not happen. And when the interest rates are lower, the cost of equity is also sort of lower, and it does help in terms of multiples or the valuations being rich. Now, one of the biggest complaint, what we or what you might hear also is that India is richly valued. I think this is more to do with the fact that this is the first time we are seeing that there is a decent amount of comfort in terms of long-term growth rate of the country, unlike in the past. And which is why I feel that things are looking very constructive for Indian markets, and that keeps the bullish bias intact in the markets. Obviously, there could be a period of correction, like I highlighted, but I think India is going to experience one of the best times going forward. That's all I have to say. Thank you so much.
Fantastic. Pankajji, thank you for this very interesting presentation. I'm sure that this initiative provides numerous opportunities for the NRIs to gain a very comprehensive understanding of India's economic growth. And accordingly, they can take more informed decisions with their investments. So now we will move to our Q&A session. where we have received questions for you for over 2,000 NRIs who are attending this webinar across the globe. But of course, due to time constraint, we will not be able to cover all. However, let me try and ask a few most common ones related to this topic.
Sure.
So our first question is, what is your medium-term view of the market?
So what I highlighted is that we could easily experience 12 to 15% kind of a growth in earnings. So even if I look at say a 12.5% kind of a growth, the Nifty EPS is somewhere about 1070, so it can easily double by 2030. So I'll not be surprised if the market also doubles by then, because like I said, we would expect market multiples to remain rich.
Okay. Okay. Sure. So the next is, should we be worried about the current valuations, especially in the mid and small cap space?
So not everything should be viewed from the same lens, because understand this, top 100 companies are large caps, next 150 companies are mid caps, and then you have 4,000 plus companies which are in the small cap domain.
Right.
So there's some bit of a overvaluation in large caps, also in mid caps, also and more so in even small caps. But you get decent number of opportunities across caps. I think it is more to do with the risk appetite one would carry. Like I highlighted, the small caps
Right.
correct the maximum, whereas the large caps witness a relatively lesser correction. So depending on the risk appetite, one can look at exposure towards stock. But I think structurally we are in a very good situation to be into, which is what I say. This is one of the best times we have even seen. We've been seeing markets for the past 20 years.
Right. Absolutely. Sure. Thank you. So the next question is, with inflation already largely controlled at around 4 to 5% levels, what is your view on the interest rate trajectory?
So globally, I already highlighted that a 50 bips kind of a rate cut is very much on the cards this year. And our sense is that India can also witness a similar kind of a rate cut. And we are comfortably placed on the inflation perspective. We all know that monsoon is going to be good this year. The inflation is going to be 4.5%. The real, the repo rate is 6.5%. So you're already offering 2% of real positive rates. Now, for saving, for channelization of savings or financialization of savings, I think even if you're keeping at 1%, real positive rate is quite decent. So our sense is that 50 to 75 bips kind of a rate cut is very much of a possibility in India. But our sense is that it will happen only when the US also sort of starts cutting rates.
Right. Got it. So I think this is the next question you would be getting a lot, and which is, what do you expect from the upcoming budget, and what sectors may get a boost from this budget?
So I highlighted a lot of sectors because see, the standard template for this government is to maintain a fiscal or discipline and do good amount of capital expenditure, which is structural in nature, or which is far more productive for the economy and less of freebies. So one budget expectation would be to maintain that capex template. But we also understand that unlike in the past, this is a sort of a coalition government, a bit strong coalition government. So some bit of a relief is very much possible, or some element of populism is very much possible, and which can provide a boost to the consuming or consumption sectors, be it consumer durables, be it FMCG, or a number of other sectors. So overall sense is that we are not going to sort of digress too much from the standard growth template which we have adopted. But yes, never say never. So I think overall sense would be that one needs to see the element of populism in the budget. Otherwise, largely things are going to be sort of maintained.
Right. Okay. So which sectors are you betting on this juncture?
I already highlighted the sectors for the decade, but if I have to sort of look at from a shorter term or next 1 or 2 year perspective, I
Hmm.
think banking is one sector which is looking very good. Because this is one sector where the valuations are quite okay. It can deliver 15-16% kind of a growth rate. There are tailwinds in terms of lower interest rate because we are going to see decent amount of bond inflows, plus the rate cuts can also sort of spur demand. So banking is a big sector which looks good to us. And infra is another sector which is looking good to us besides cement. Steel, I think, if depending on how China sort of behaves or any kind of a measure we take, steel is another sector which should do well. But I think it's contingent upon how sort of China shapes up, or do we take some measures to sort of protect the industry?
Right, right, right. So a lot of positivity across. Which are the sectors which are likely to be the laggards that you think?
So IT of late has done very well. The recent commentary looks positive. At least it looks like that the worst is behind us for the IT.
Hmm.
But our sense is that IT is going to be a sort of a structural laggard because what we are going to see is that see the normal dollar revenue growth for IT industry is about $5 to $7, 5 to 7%, uh, and currency used to sort of depreciate by 4-5%. So that used to give them 12-13% kind of a growth rate. But I think going forward, currency depreciating by 4-5% does not look like, at least last 1.5 years, the RBI has been maintaining currency in a very tight range. So if you are going to grow at 5-7 odd percent in rupee terms, then you are going to lag the Nifty earning growth of 14-15 odd percent. So which is why IT, it can do well in the shorter term, but structurally, I would want to believe that it is going to lag. FMCG is another sector which should lag because FMCG did very well with low double digit kind of a growth rate because that was the only sector which was offering longevity of growth rate, and which
Right.
I think multiples had sort of gone higher. So this is another sector which I feel valuations are rich. Growth will not be higher than what you see for the overall Nifty earnings. So another laggard and historical outperformers. I think somewhere down the line, I feel that they are not going to sort of do that well because some of these stocks, I mean, I'll just highlight the example. It's not a recommendation. So be it HDFC
Hmm.
Bank or be it Bajaj Finance or the likes of number of stocks which are there in the FMCG, Asian Paints. I think all these did well because they were offering a stable growth rate. So valuation got rich because most of the other pockets of the market were struggling. But now
Right.
things are becoming a lot more broad-based. So I would expect these historical outperformers to sort of underperform.
Great. Perfect. Thank you. So the next question is, what global factors are important to watch out for in the next 6 months?
I think people in the US will know. I think the US elections are the far more important.
Important,
I think
yes.
it's one of the largest economies or the largest economy globally. So obviously, a lot is riding in terms of who's going to be because it will have implications in terms of growth rates also or the kind of policies being followed. So I think U.S. elections is the by far the biggest event to be sort of watched out for.
Hmm. Great. And so how do we expect the corporate earnings to grow over the next 2 years?
So we already had a good sort of run up in the corporate earnings. Probably the growth could be in the range of 14-15 odd percent. So for example, we are expecting Nifty EPS to be say 1017 FY25, and next year it will be 1250. So a low teen kind of a growth is what we are anticipating, and because margin is already at a peak, so Nifty margins at about 19 odd percent is already one of the peak we have seen. So growth is going to slightly moderate from here on, unless we see rate cards and see benefits of those rate cards flowing in. So till that time, I think low teen is what we would expect.
Okay. 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 And what are the risks to the market now?
So one risk, obviously, for markets is that, say, while U.S. election is the most weighted event, it could have implications across markets because it will also depend on what kind of policies the U.S. Fed follows. And the kind of taxation relaxation whether corporates get.
Right.
So it will have implications, or the kind of aggressiveness, what is or towards China, which US will adopt, or the kind of tariffs they would sort of levy. So because it could have global implications across the growth of some of the key sectors. But for India, I think largely, see, what we export is mostly services, which is a manpower-driven business. Not really impacted so much by that. And manufacturing, we are still sort of quite small from that perspective. So I see lesser of an impact on the markets. One positive thing can be that if the US cut Fed rates, you'll see a lot more fund flows coming into India, and that will benefit key sectors
Right.
like, say, banking or even IT to some extent.
Right. Right. Okay, so we'll take one last question for the day, and that is, what is your view on overall green energy focus on the economy, and which sectors will benefit from the green energy drive?
So power is one sector which is clearly going to be the biggest beneficiary. And I think what is happening is that while we are shifting the energy consumption mix, so earlier you had crude oil, you had coal, and you have number of other energy sources. Now the anchor energy source is going to be renewable energy. So obviously, power is one sector which is going to see the maximum investment, not only in India, in fact, across globe. When you speak to
Right.
companies, what you sort of clearly notice is that there is a shortage of transformers across. You really do not have capacities for the next 2 3 years, not only domestically but globally also. So power is seeing a big transition. It is one of the few sectors which are going to witness a long tail of growth for the next decade or even beyond. Then I think auto is another sector which is experiencing a quite a fundamental shift the way it operates. And we are already seeing big companies in India also sort of catching up with that particular trend. So I think power and associated sectors, so be it capital goods, be it other segments of the market, say for example, someone who's supplying transformers, cables, all of it should benefit. And also the auto as a sector is going to be another beneficiary of that.
Okay, fantastic. So thank you, Pankajji. With this, we come to the end of today's session. So thank you so much for sharing this insightful presentation with us. We hope you found the session useful. We also have a feedback form for today's session, which will appear on your window. I would request all of you to take a minute and fill the form to help us make our sessions more insightful and relevant for you. So as I mentioned earlier, we will bring more high impact sessions on multiple topics in subsequent months. Thank you so much, Pankajji. Thank you everyone for joining us today. We look forward to seeing you again in the next webinar. Until then, please take care, stay safe, and bank on us. Thank you once
Thank
again.
you.
Thank you.